I get asked a lot of questions about what happens when the Fed starts raising rates. The Fed has been talking about rate hikes for the last 2 years. The Reserve Bank of India has pointed to the possibility of Fed rate increases as one of the risk factors that is keeping them from cutting rates this year. People remember what happened 10 years ago. In 2004, the Fed started increasing interest rates and kept raising rates for nearly 2 years, taking rates from 1% to 5.25%. During this period, yields on Indian government securities and in general yields in India rose. So people make the immediate assumption that the Fed was a cause for rising yields in India. But if you look at the data, what's immediately obvious is that while the Fed was raising rates, so was the RBI, Reserve Bank of India. And the market was responding to the RBI and not to the Fed. How do I know that for sure? In 2007, you see a divergence between the Fed and the RBI when the Fed started to cut rates and the RBI continued hiking rates. And the Indian markets followed the RBI, not the Fed. Therefore, in this scenario, firstly, should the Fed hike rates and the RBI cut rates, we expect that the Indian markets will follow the RBI towards lower yields and not the Fed towards higher yields. Going back to 2004 to 2006, the spread between Indian and US rates at the start of that period, when they were at 1%, we were at 4.5%, a spread of 3.5 percentage points. By the time the Fed ended its rate cycle at 5.25%, Indian rates were at 6.5%. What that means is, during that entire period, the spread between Indian and US rates varied between 1.25% to 3.5%. And yet, during this entire period, flows came into India. During this entire period, our exports did well. The currency did well. Indeed, by 2007, the currency was closer to 38 to the dollar compared to the 50 to the dollar at the start of that decade. So it appears that the Fed rate hikes was good for us. Why was that the case? The Fed hikes rates because the US economy is doing well and they believe that the economy can sustain higher interest rates. A strong US economy means stronger exports and higher growth for India. This is not bad news. Therefore, we believe that the US Fed cycle will be far more benign than what people fear it to be. On the other hand, let's look at another risk which has emerged of late, the risk in emerging markets. Starting with the China currency devaluation early in August, we have seen emerging market currencies fall across the board. While the Indian rupee has also participated in this fall, our fall has been very small, 3 to 5%, compared to the much larger falls across the rest of the emerging market space. What risk does this pose for investors? The worry, of course, always is what happens if foreign investors start pulling out. Put yourself in the shoes of a foreign investor. Yields on Indian government securities are close to 8%, and the currency is perhaps down 3 to 5%. So your net still positive in dollar terms. Yields in other emerging markets which offer above 8%. Let's take Indonesia, certainly above 8%. The currency is down about 15%. Let's take Brazil, double-digit interest rates, and currency is down perhaps 20-25%. Or Russia, in fact, where the yields are above 8% and the currency is down at least 15%. So what this means is that when you look at the broader space, there are very few countries which offer high yield and yet with currency stability. And that is the reason why foreign investors continue to buy Indian bonds even as they are exiting other emerging markets. Last week's auction of limits on Indian government securities were well bid, again indicative of the appetite of foreign investors into India. The only reason why there has been no net purchases in Indian government bonds has been the fact that the FII limit has been used up. So in short order, the two big risks, the Fed and the emerging markets. The Fed is unlikely to have an effect over the medium term, and the emerging market crisis is passing us by, at least for now. We will keep an eye out to see if there are any further developments in the currency markets. However, at this point of time, it does appear that the positives we have, including the improved current account thanks to the lower oil prices, outweigh the risks on the FII flows.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.